In my view, all businesses are the same. It's revenue minus expenses equals net income. How you get that net income out of the business is based on the type of entity you've chosen to be. If you're a sole proprietor, that net income comes out as a draw. If you're a partnership, it's basically a sole proprietor with more than one owner, it also comes out as a draw. As an LLC, if it's a one-man LLC, for tax purposes, it's disregarded and treated like a sole proprietor, so your earnings come out as a draw. Yeah, an LLC, a one-member LLC is disregarded for tax purposes, so there's not a separate tax filing required. It is reported on a Schedule C inside your individual return. The self-employment tax and the income tax on the business become part of your personal liability on your individual tax return. A flow-through entity, a partnership or an S Corp, files a separate return, but it's an information return only. The net number gets reported into your individual return on Schedule E, page 2, and you're taxed on the income there. In an LLC, you're also taxed on the self-employment income on your personal return. In an S Corp, you're treated as an employee and your self-employment tax becomes payroll taxes within the S Corp before it comes to your personal return. An LLC, again, a business is revenue minus expenses equals net income. In a LLC or a sole proprietor, that net income, the full amount is subject to self-employment tax. When you take that over to an S Corp, we break that net income into two pieces. We break it into a wage piece and a non-wage piece. And you're only required to pay payroll taxes on the wage portion. So for most businesses, an S Corp will create a lower self-employment tax or a lower payroll tax than an LLC because you can control the amount that's being subjected to payroll tax. To form a separate entity, to file a separate return, to do the quarterly payroll reports and the federal deposits and everything, there's a cost to that. To get that savings, you've got to jump through some hoops and do more administration. We feel about $30,000 of net income is where it makes it worthwhile to consider an S Corp versus an LLC. People ask me, do I have to do this? Do I have to keep books and records? And the answer is yes. The very simplest reason is the IRS is going to want to tax you on what you make. So the IRS requires you to keep a set of books and records that clearly reflect the income you made. They don't care as much about the balance sheet as they do about the income statement. If you are forming a separate legal entity, such as an LLC or a corporation or an S Corp, then the state requires legally that that separate entity have its own set of books and records that's separate from yours. As a Schedule C, a sole proprietor, you can mix your business and personal, although I don't recommend it. So if you have formed a legal entity to give yourself limited liability, you are required to keep a set of books and records. And so that's one of the reasons to do accounting. Filing a tax return is a necessary evil, and that's the only reason I do books and records, because they require me to. That's the wrong attitude. The books and records that you're keeping are tools to help you understand your business better. It will flag excessive expenses so you can start addressing them. It can show inventory costs being higher than you expect, so either you're not charging enough or stuff might be walking out the door. So it's a control function. You're going against your plan to tell yourself whether or not you're on plan, whether this business plan you developed actually works.